equity markets have just continued to go higher and higher and higher, irrespective of the risks or valuations really.
Investors who are deep into the information in terms of the portfolio construction are aware that they've been left with some of the macro changes around, US Treasuries, for example, is what used to seem like risk-free cover is not that whatsoever.
The Australian landscape has changed dramatically and we are highly regulated.
There's small operations doing very investment strategy specific products and meeting a need in the market. You've got your mid-tiers, maybe a little bit of a philosophical navel gazing in terms of what's their purpose going forward. They're not small, but they're not big. They're kind of stuck in the middle ground. Then you've got the whales. Who are the winners then?
The absolute beauty of the industry at the moment is that scalability. So you can now run assets with much fewer people and with much better infrastructure.
Welcome to the CoreData podcast. And I'm really excited to have this conversation today about the alternatives industry and the threats and opportunities facing the asset management industry. With me in the studio is David Sokulsky of Carrara Capital. Welcome, David.
Thank you. Great to be here.
So to kick things off, how would you summarise the current landscape in the Australian funds management industry from an alternative manager's perspective?
Yeah, look, I think from an alternatives perspective, it's actually quite an exciting time because what we've seen is a real shift from what I'd say sort of generic beta products, and that's certainly the way the ETFs have sort of taken control of that market. And people are really looking at the alternative space is the place that they can add value in a portfolio. So I think the opportunities for alternatives in portfolios is huge. There's still very much an underallocation to alternatives. And I think what people are really trying to get their heads around now is how do we assess the risks in that sector? How do we balance up the liquidity in the sector and the illiquidity with some of the products? And overall, how do we build that into a portfolio when we see equities continuing to go up, and hence what we're getting for a pure beta play at the moment is quite good. Yeah. So, how do we allocate now to alternatives when we don't know what the future is going to look like? So, it's a really exciting time in the space, and you've seen a lot of new products come out, particularly, let's say, credit over the last 3 to 5 years. So I think that excitement factor is very good, okay. But there is a huge amount of challenges in terms of having the end investor and the advisor understand what the risk and return and the portfolio construction metrics are.
And I guess, alternatives is a very broad umbrella for somewhat very different investment types. How would you summarise which areas are fastest growing at the moment? You just touched on credit there, and we can talk a little bit about your operation shortly. Where are the fastest areas of growth then for alternatives? In terms of demand and pull.
Yeah, look, I'd probably separate alternative into probably 4 buckets, okay. In broad terms. One is your sort of more liquid credit alternatives. The second is more illiquid credit alternatives. The third is hedge funds, and the fourth is venture capital / VC. You can probably split them out into 2 themselves. And each one of those alternative categories offer a very different risk return profile. What we've seen probably over the last 5 to 10 years is a real growth. If you go back 5 years ago, a real growth in allocations to private equity and VC. And that was certainly where a lot of capital was going to. Now you've got a little bit of a problem there in terms of investors being locked up into an illiquid market because that IPO market has stalled a little bit. And you've also got a situation where a lot of the funds are not taking in new capital, so you don't have the exit that a lot of those private investors would have wanted. But that's certainly a big part of people's portfolios at the moment. That sort of led into where we are now into credit and that private and public credit. And I make that distinction because the vast majority of credit funds in Australia are property orientated. And the more liquid side of credit is very different when you're looking at securitized products, structured products, and even very simple sort of corporate debt. So, you look at that, and we've seen a huge allocation shift towards that sort of public credit because the risk profile is very different to what we see in the equity market.
Okay, and if we just sort of pin in the map at the moment, this point in time, where we are, if we take a step back at the broader macroeconomic environment, you mentioned some of the lockups in the VC, and obviously there's some areas of those markets have ran quite hot here and elsewhere. If we're at the top of the cycle in terms of robustness, performance, and so on, let's say you're a broad-based asset manager, where would you be lining your chips up in terms of a focus, let's say, for the next 2 to 3 years? Where are the opportunities to sort of drive forward?
Yeah, look, and I think the answer in that sort of alternative space is a diversified mix of a number of products, and that's probably the easy answer to give, but that's the reality, and that should always be the reality. Okay. But certainly, I think we are seeing a bit of that private credit start to turn. So we are now seeing the risk come through in a lot of those products, which we haven't seen for the last 3 to 5 years. And I think that's making people question, is the returns, or are the returns that we've got over the last 3 to 5 years sustainable? And we are starting to see a change in return profile there. So I think having a more balanced, non-property orientated credit exposure is going to benefit a lot of investors.
So where do you look for then, if you're looking outside of property? What sort of origination are you looking at for the credit products?
So I think, if you look at, say, where we're allocating to in our fund, you've got a lot of securitized products where you're getting a really good return for the risk that you're taking. So things like asset-backed securities are looking attractive and have looked attractive. Spreads were certainly attractive 2 years ago. They have contracted a little bit, but when you look at the risk profile of that versus, say, the risk of a direct property loan, it is very different. Yeah. And your liquidity profile of that is very different. And if you had to work out the asset in default, it's very different.
What's driving that sort of compression in the spreads? Is it just the competition on the underwriting side? More providers rushing in to sort of get access to the space?
Yeah, I think it's the latter. It's more providers coming in, and so what you've now got is, with the hybrid market in Australia pretty much shutting down, the brokerage networks are looking for replacements for that hybrid network. Okay. And so what they're now going into is more the sort of public or asset-backed securities market to replace that. Okay. So the listed investment trust, the lit market, which we're seeing, several of the big firms come out with pretty much each month now, that's soaking up a lot of the allocations through the brokerage network. Okay. And that is then going into more of the liquid credit market.
Okay. So if we just stick with credit for a second, then, I mean, would you go as far as saying, is it cyclical then? If we're coming into a downward, maybe not back down to 2010 but base level of rates, but is there still opportunity in credit as the rates come down and some of those margins sort of narrow at the?
Yeah, look, we definitely think so. And again, it really does come down to the risk in those markets. What we've had with this whole proliferation of money coming into credit is that a lot of that credit hasn't seen a cycle yet. And we are just starting to see a bit of that cycle with the economy starting to turn down a bit. So we are seeing that very much on the private side, whereas the risk still in that securitized asset market in the more liquid side still looks attractive. And this is where, we're trying to get the message through to a lot of advisors and a lot of end clients that credit is not just one product. There's probably 4 or 5 different products along the spectrum. And when you're looking at credit as an asset class, there's scope to have some in private, some in liquid, some in between, and just really looking at that, like we've looked at equities for the last few decades, where you've got small cap, mid cap, growth, value, offshore, onshore. Credit is now very much the same as that because advisors have the choice. Okay. So you can almost build a sub-portfolio of credit allocations like we build a sub-portfolio of equity allocations. Yeah.
Let's just talk briefly then about the broader spectrum there. So there's commentary or evidence that hedge funds have come back into vogue, for example, after some time in the wilderness, and just given a lot of challenges facing governments around the world, infrastructure limitations, there are opportunities there. Does the industry have the product set in terms of covering all those areas to offer what the investors are looking for in terms of diversification? Do you think there's a good mix, including what your business provides and what others are doing, or can the industry do more in that area?
Look, it's a tough one, and for us, we run both a credit fund, which is very much more on the liquid side, and a global hedge fund, which has a low correlation to equity. So we have two sort of buckets that we potentially fall into. On the hedge fund side, the absolute return model, there's definitely a space in pretty much every portfolio for that hedge fund / absolute return exposure. The problem that we've seen over the last sort of 5 years since COVID, if you like, is that 3 years now? I tend to forget how long ago that was.
5 years, yeah. Or it depends. Yeah, some countries took a while to come out. Yeah.
Is that equity markets have just continued to go higher and higher and higher, irrespective of the risks or valuations, really. So, a lot of people are sitting there going, well, why would I want a hedge fund that's maybe doing 7 to 11% when my NASDAQ ETF is doing 15? Yeah. And so they've just got that recency bias where they're not seeing the value of that diversifier in their portfolio.
Yeah, I mean, we can touch on a whole bunch of things there. I mean, at the more sophisticated end of the spectrum, from our research, we're seeing calls from institutional investors, family offices, for example. They get it. They know that's not free money. They know that there's no net underneath that, the ETF growth there. So they are pushing for more alternatives in that broader suite. Some of the flattening of the correlations between, your bonds and your equities, and a lot of the dismissiveness around, that traditional mix. One thing I just want to dig into, more as a fun thing to do, is, so if I was looking to start a asset management company, or that sounds a lot. Let's say I was looking to launch a fund today. Distribution. So what are the pitfalls of trying to convince the market that I have an alpha generating proposition is something that people will want to look at?
Yeah, look, starting a business in the absolute return space in Australia now is very difficult, is what I'd say. And it's certainly much easier offshore, where you've got a lot greater acceptance of where those alternatives fit into a portfolio and where investors are willing to take risk in terms of seeding new managers or allocating to early stage managers.
Okay, so let's dig into that a little bit then. So what are the specific blockers in terms of why that can't get up? Is it the research houses don't take a look at you? Is it the super funds are too big to even consider, or that they have different risk profiles? Is there anything you can draw on?
Look, they're both really key reasons in terms of why there is that differentiator, because the Australian landscape has changed dramatically, and we are highly regulated as a financial services industry. There's certainly some value in that, and the regulators do a great job of protecting investors, but they also make it really hard to get things off the ground and for the end investor to take risk. Okay. So, if you go back 20 years ago, there was, close to 200 super funds, and a lot of them very much on the smaller end, who were willing to take risk and seed managers and allocate to early stage managers. Yeah. They've now gone away.
But that's a critical function of innovation, though.
Yeah, that's sort of if you look at sort of the life cycle of financial services and the asset management industry in Australia, that's where you got a lot of that seed capital and a lot of that innovation, a lot of that growth. That's now gone away. Right. So the fact that we're going to probably end up with 5 to 10 big super funds means that they're all going to be too big to seed young managers.
Do you think it's then a case of you don't know what you don't know? So the super funds will continue doing what they do, offer their mix of investments, have their performance, but essentially they're missing out on a broader potential better performance by not having some of these innovative areas included.
Absolutely. Like if you look at what a successful asset management business should deliver in terms of IRRs and yield to the end investor as a shareholder, you should be building a business which is probably 30, an IRR of 30 and a yield back to investors of 40% plus over the medium to longer term. That's a return that's very hard to get in any other sector anywhere. So the asset management business for a potential investor at the shareholder level should be very attractive.
Okay.
But it's not in Super's best interest to do that because they're very much benchmarked. So their idea is not to take risk to outperform, it's very much not to underperform. So there's very little incentive for them to take that risk, whereas, they used to do that.
So where are the distribution chances then? If it's not at that top end, are we looking more at the sort of top of the high net worth spectrum, into the realms of family office, non-profits, the people that can take a punt because they're not they're not hamstrung by those restrictions?
Yeah, well, I think that is exactly where the opportunity is, probably more so in the family office space, because they have the discretion to largely make their own decisions, or they might have an internal chief investment officer, or they might have their own internal investment committee where they can assess the risk, and they're much more willing to deploy capital for that return. The high net worth advisor market is also extremely attractive once you get up and running and start to build your track record. The biggest thing there is there's a lot of gatekeepers on the way.
Yeah.
Whether that is the internal chief investment officer, who is rarely incentivized to take risk. The high net worth advisor part of the market is certainly attractive from that capital raise perspective and distribution perspective, but there's a number of hurdles you have to get through to get to the end investor. One of those is obviously they may have an internal chief investment officer or an internal investment committee.
Is this within the advisory network, the licensee we're talking about?
Yeah, exactly. So one, you've got the individual wealth advisor or financial advisor, then they may be part of a larger advisory group. And then so you've got a couple of steps along the way there. Then you've got potentially a model portfolio which they use, or they've got a ratings that they require. And then you've got to be on a platform to actually get access to the fund. So this and every step along the way, you've got to have a box ticked to get through. So once you have all those boxes ticked and once you have access, then the distribution through an advisory network is probably the asset manager's best way of raising capital.
Okay. So chicken and egg scenario, what comes first there? Are you able to get on a platform without the rating, or can you get onto the platform and then have the advisor push you to get onto the platform? Where's the influence coming from in that sort of ecosystem?
It's probably the best question that you could ask in that environment, because it is very different depending on who the advisory group is. Some don't have any kind of process that they need to go through, and they're like, we love what you do. We've spoken to you a few times. We understand the products. Let's go through. And then we just need to get you on a platform so we can access. Others are sitting there going, we love what you do, but we need a rating. And then the rating agencies have their own criteria for how they rate and when they start rating. So it's all different with different groups in terms of what that process is. Okay. I think at the end of the day, you need to have the advisors being supporters of your fund, and then they can drive demand through both the platform and the rating agencies. So that's probably the chicken and egg sort of question. To us, it starts with the advisors, building that trust, building that relationship, them understanding what your investment offering is, and then them driving a lot of the process to be able to access you.
And so how is that done? Is that through visibility? Do you present at conferences? I mean, how do you get that? Obviously, you're not a BlackRock, so how do you invest in collateral to educate the advisors in terms of the merits of the end proposition and things like that?
Look, it's hard. It is probably the easiest answer. You can hire a distribution person to do that, but the good distribution people, are either tied up with a very large fund manager who's paying them very well, and as a small fund manager, you want to look at your costs. So often that's not available. So that's the obvious answer. The less obvious answer is, do you present at conferences? Yes, but you've also got, 50 other people at that conference. And I think advisors get sick of people coming in and selling them stuff all the time. So our approach has very much been build a relationship with the advisor or their clients, and have them trust us, and for us to offer them essentially full transparency on what their clients are going to be investing in.
Yeah.
That trust is still, I think, the key driver in our industry. So, for us, it's less of a sales process and more of a trust process and a transparency process.
Does the advisor then become the projector of your value? So it's a third party person not referring you, but talking about you to other advisors and building the pathway that way?
Yeah, definitely. So the client trusts the advisor. That's why they're their advisor. And then, we want to build trust with the advisor. So that is the best way of doing it. And then have the advisor, driving that process, both for us and their client. So, if you can't go and ask your fund manager what they're invested in or explain to you what they think of the market at the moment, then I don't think you should be invested with them. You should know where your money's going.
Yeah. So let's just jump. So that's a really intriguing sort of segment of the market. But if we just look at the mid-tier space, a lot of these not inconsequentially sized managers are being pushed from the whale end of the market. Options open to those guys. So theoretically, M&A, find another similar sized manager, push together, challenges, cultural integration, process integration, all those things. Is there much of an appetite for, if we talk about the appetite for alternatives from the demand side, the end investors were all the way up to the maybe not the instos, but based on your type of, not your type, but newer sort of offers. Is there any plans, or are you seeing any activity in the market where managers are acquiring small single product, or, I mean, obviously if you've set up an asset management firm, you don't want to sort of sell out to a mid-tier manager, but how are those mid-tier managers getting access? If they're not experts at alternatives, whichever area of the market it is, is there any opportunity there for co-benefits in terms of they get scale, they get access to sophisticated areas they're not delving in, do you think?
Yeah, I mean, I think from the smaller manager's perspective, the two things that, say, we would seek from a partner is either working capital, if we needed it, and or distribution, if we needed it. So that's really the only reason a small manager would give up equity in their business, if they can get distribution for scalability or working capital to keep their business growing.
Okay.
So now, outside of that, you should have the expertise in-house to run your products. And we've spoken about some of the difficulties of getting an asset management business up and running and getting it to scale. The absolute beauty of the industry at the moment is that scalability.
Okay.
So you can now run assets with much fewer people and with much better infrastructure.
Let's dig into that a bit. So the technology underpinning that scalability, how does that work in practice? Can you give some examples?
Sure, like even if you look at, there's a couple of things. Let's talk, firstly, transparency and information flow. 10 years ago, there was no podcasts. So now we can actually sit here and talk to potential investors or talk to our investors really openly about what the market looks like and what the portfolios are. So the ability to use technology to inform people is streets ahead of where it was 10 years ago, and will continue to develop because our ability to reach multiple potential markets or investors is much better. So that's the first thing. The second thing is the infrastructure of your business. And this is where the back office and middle office process has improved dramatically. In our business, we outsource most of our middle and back office, and we have a chief investment officer. We don't really need to employ too many more people, if any people, to run multi-billion dollars.
Okay.
So, again, 10 years ago, you would have probably had to employ 5 to 10 people at minimum. So the scalability from a profit of the asset manager is now much better than it was.
If we map that out across the industry then, so is that a death knell for, let's say, certain areas of the asset management industry from a personnel perspective? Whole areas where you may have been head of administration, or I wouldn't say compliance because there's always going to be a need for compliance, but are there areas where whole teams are now just becoming obsolete?
Absolutely. So if you look at, say, that operational side of things, you historically would have had to have 5 to 15 people in operations to run what we do with one person. So you don't need that scale of operations of middle and back office staff anymore. Even on the
Are
investment
firms doing that?
Absolutely, yeah.
Gutting, okay.
So if you set up your business from an infrastructure perspective from day one, the scalability is really attractive. And this is where, if you're looking at, say, a custodian and a broker and your, middle and back office, you can tie all that together largely and have very little trade breaks and just have, one information source going directly to the other information source, and your pricing's very simple.
That's fascinating.
And it's all independent, which is what you want. You don't want to be pricing things internally to any great degree unless you have to.
So let's do a little forward jump then. So we've got map out 5 years from here. We've got, that's very simplistically to say, there's small operations doing very investment strategy specific products and meeting a need in the market. You've got your mid tiers, maybe a little bit of a philosophical navel gazing in terms of what's their purpose going forward. They're not small, but they're not big. They're kind of stuck in this middle ground. Then you've got the whales. Who are the winners then? If we come all the way back to the investors in terms of what they need and demand, who's going to win and how are they going to win in that battle into the more esoteric area?
Yeah, look, I'm obviously going to be a little bit biased with this answer, but
you're Carrara.
I think the mid-tier asset manager who can reach scalability and keep their costs under control is going to be a big winner on the manufacturing side, because they can deliver alpha and they can keep their cost base very low. And the advent of AI, and everyone talks about this, but the need for a massive investment team now has been again reduced. So not only in operations, but investment-wise, if you use AI correctly, the amount of information you can get and digest, which would have taken probably 2 analysts a month to do, I can now do that in 2 hours. So using that information set right, using AI right, the ability for us to digest information, process trades and everything else is light years ahead of where it was. The bigger managers can still benefit, but they are largely on a race to the bottom in terms of fees.
Yeah.
And so for them, scalability is about cutting fees as much as possible and trying to get huge mandates. So both can do well from an asset management side of things.
So you can scale in that middle space, but shaving costs, or not shaving costs, not having to spend money.
Exactly.
While remaining competitive on the fee side, maybe not as much as you would have been able to charge for some of these strategies, say 15 years ago. So you're kind of growing while standing still, if that makes any sense.
Yeah, the idea is you keep your cost base well under control, and you continue to increase your revenue base. So, and the fee structure, we probably won't get into that now, but the fee is very much an Australian dynamic as well. If you go offshore, the focus on fees is almost non-existent. It's really an Australian-centric concern for the advisors. And
what's the priority offshore?
After fee returns.
After fee returns.
Almost every country in the world wants after fee returns. So if you're getting 15% after fees and you're charging a 3% fee, in the US no one cares, because they care about what they get after fees. And that really is where that alternatives market comes in. And that's why you're not fighting to the bottom on fees, you're actually fighting to the top on alpha. Yeah. That is really the key.
Yeah, our research digs into that. It's just investors who are deep into the information in terms of the portfolio construction are aware that they've been left with some of the macro changes around, US Treasuries, for example, is what used to seem like risk-free cover is not that whatsoever. So they're having to and they're using a lot of externals to try to understand how do they reposition their portfolio for the next 5 years, given some of those significant shifts, the reliance on the US dollar, for example. So that brings in a whole bunch of hedging considerations they didn't have to do previously.
Well, I think that leads into the other big winner here, and that is the advisory groups that understand the breadth of product available to them and that can build a portfolio which spreads across all of those products. Yeah. So when do you want, and in what markets do you want a low fee access product? And that might be large cap Australian equities. Yeah. So what does your portfolio look like, and where do you want to spend your fees, and who's actually contributing the most? And some of that may be to smaller managers, some of that may be to large cap ETFs. and just really understanding how their portfolio fits together is really important. So for an advisory group to build their investment offering from both a technology perspective to understand what's available, and then from a portfolio construction perspective to understand where they're getting alpha, where they're getting beta, how much they're paying for each of those, and how that portfolio looks together is really important. So just thinking about that equities have outperformed for the last 3 years does not mean they're going to outperform massively for the next 3 years. Same as, private credit's done really well for the last 5 years, but doesn't mean that's going to be the same. And likewise, private equity did well for the 5 years before that, but now not doing so well. So understanding that medium to long-term investment offering, utilising technology and transparency from managers allows a really good wealth advisor to benefit from this environment massively.
Yeah. Okay, so just to wrap up, maybe just on the education side of that, so not all advisors are created equal. Is the industry infrastructure on the distribution side there? So a lot of the digital platforms, the move will logically move towards very personalised solutions, digitally created. You mentioned how AI is supporting the managers, and then you move into your wholesale, and then you've got the family office and the private, the non-profits, and then the super funds and so on. It seems to me from what you're saying there is that the potential for the asset management industry is robust, and the opportunities are there for the groups that make those right decisions to benefit from a lot of these changes that we're seeing. But perhaps on the distribution side, that's where the growth needs to come from in terms of development and consideration, and it's who's going to educate all those advisors that need the education to be able to offer these changeable portfolios and so on. Who's going to invest in the technology in the middle section to actually deliver those personalised portfolio building? And I know there are a lot of robo platforms and so on and so forth, but true personalisation, for example. And then obviously you've already touched on some of the challenges on the super side. Just to end that with a question, how does that get fixed?
It's a good question.
Sorry for that being the last question, because it's a meaty one.
Yeah, look, we are seeing an evolution there. I think that the real key to sort of bring all that together is we're still a market dominated by people focused on individual products versus overall portfolio. And I think that the more education we do to have the end investor in understanding that what you're after is an overall portfolio return, and that not every single part of your portfolio is going to outperform every single year. There's times when equity is going to outperform, there's times when credit's going to outperform, there's times when both underperform, and alternative in terms of hedge funds outperform. So just understanding that it is a portfolio return which is most important. A lot of people have now completely forgotten that the standard return from a client portfolio, say for a balanced fund, was CPI plus 3 to 5%, which is 8% probably at the high. People have forgotten that is their long-term target return, and now they're expecting 12% plus to be normal because that's what equities have done for the last 3 years. Yeah. Getting back to that long-term perspective on what should I expect from my portfolio and how should my capital grow, I think we really need to make sure that people remain focused on that.
Okay.
Because that is where we're going to continue to focus on risk and the risk of overall capital loss. I think a lot of people have forgotten about risk over the last few years.
Okay, I think that's a really nice point to leave it on then, David. But I appreciate you coming in today.
No, thank you.
Thank you. And if you'd like to hear more from CoreData and what this all means, contact me on craig.phillips@coredata.com.au.